Hi, everyone. I'm back with Steve Ehrlich. So, Steve, you wrote a great story this week about how one funding mechanism for this whole crypto treasury company trend can really affect the potential performance for investors. And in fact, based on your research, you actually identified potentially four treasury companies that you believe are primed for a price crash. Tell me about the key findings from your story.
Thanks, Laura. So I was very interested in the collapses that happened, I guess, a couple of weeks ago with two companies, Apexi, which is focused on Solana, and SharpLink, which is building an Ethereum treasury. What I wanted to find out was whether or not, what are the chances of history repeating itself for the most part? Because as anyone who has been following the crypto treasury, uh, I guess, trend in the space, um, we knew that there were many other companies that were following a similar playbook. Those were Bitmine, which is focused on Ethereum, asset strategies, or I'm sorry, asset entities, which is merging with Strive, Bitcoin, Justin Sun's Tron company that's merging with a firm called SRM Holdings, and then the final one was David Bailey's Nakamoto, which is merging with Kindly MD, also focused on Bitcoin. And each one of them raised at least $100 million, oftentimes more, through pipes in order to sort of kickstart this accumulation phase that comes with launching one of these companies. Pipes can be a very useful tool in in launching these firms, especially when size and time really matter, because you can get all this money up front. You can use it to then deploy it to get the crypto, and you don't really have to pay the bill later in terms of having to. You don't have to pay that bill until later in terms of having to give the shares to the shareholders and then ultimately flooding the market. So that was what we all knew that was going to happen. But what I really wanted to find out was what are the chances of mass dilution events scaring investors in the same way that they did for investors in SharpLink and Upexi. So I was very curious to kind of go into the SEC filings to find out exactly how many shares were sold in these private rounds to investors, many of which were the same crypto VC firms that have been dominating the space for years, and what base of a circulating supply of shares they're building on top of. And the numbers were surprising to me. I would mention to you and to many readers we heard about ever since we published the story, because in virtually every single case, the companies that were either doing the acquiring of emerging, these were penny stock firms with very little like traditional businesses, small revenue, small circulating share bases. And what we found in the research, or what I found in my research, is that the uh, the new shares were going to massively dilute the current base, sometimes somewhere between like 10 and 20x increase in the shareholder base. And that's just essentially, that's just a time bomb waiting to go off. And the real question was when. And up until that point, no one had really taken the time to do the work to really figure out like what types of dilution events, what size of dilution events were we looking at. And that's what I wanted to understand with this story.
Yeah, and actually, you said 10 to 20 times, but one of them was almost 90 times, which was, I mean, that one already, that was SharpLink, and already the shares had been, able to be sold, and that may have been part of the reason that the price tanked. So both that one and Upexi dropped by about 70, and then they sort of leveled off a little bit higher. But that was what kind of led you to say that these others could also drop. So explain why it is that pipe deals are especially problematic for these treasury companies.
Well, again, as I said, there's different ways for companies to raise money in these types of companies. Pipe shares is a good way because you basically hire some sort of broker or a placement agent. You can raise a lot of money quickly, and you don't have to sort of deal with the problems of going to the public markets and having to sell to shareholders that don't know the company and don't understand what you're trying to do. And if you're trying to sell to these people off of a very small shareholder base, there's a lot of legwork. So you may not be able to raise the amount of money you want as quickly as you can. Convertible debt is another way, and many of the rounds that I detailed in the story also included a convertible debt component. these have been very popularized by Michael Saylor and Strategy. That's one of the ways that he's raising his tens of billions to build his stockpile. Convertible debt shares often have a term or a maturation date several years into the future, at which point the holders of the debt can then either get their principal back or they can convert into shares at hopefully an advantageous price compared to the spot price at that point in the future. But the risk with convertible debt is that if the company is struggling or it's not trading at a premium to NAV, then the company would have to sell its crypto to pay back the principal. And that can lead to sort of a cascade of liquidations and other types of price issues that companies want to avoid. With equity, they don't have to do that. So pipe, in certain ways, is a Goldilocks scenario. And actually, for the story, I was able to speak with Brian Rudick, who is the new chief strategy officer at Lupexi and actually helped lead the funding deal for Lupexi when he was at GSR. And he basically kind of walked me through the thought process, because I asked him when I interviewed him, like, why did you choose to go this route? Because it was plainly obvious that this was a risk that could happen. And essentially, readers can see his full comments in my story, but it kind of boiled down to the company knew that this was a possibility, but the ability to get scale and speed was worth the potential downside, the potential trade-off. And as you said too, I mean, despite the big price drop, Laura, the Pepsi and Sharplink, I mean, they're still above where they were when they started. So it's not like they've given up all of the gains. It's just that there was a huge run-up that was clearly unsustainable, and then it has retreated.
So something interesting happened after you published on Wednesday, which is that one of the stocks that you mentioned, Bitmine, saw a collapse. It dropped by about well, in intraday trading, I think it dropped more than 50%, and then by the end of the day was at 39%, and lower than where it had started. What happened there, and what are the takeaways from that incident?
So actually, I think it also dropped a further 20% or so today. So not sure where it'll be by the time people listen to this on Friday, but it looks like the sell-off did not completely end on Wednesday or by Wednesday evening when we published that story. But what happened in that case and was that Bitmine filed basically a registration form to issue new shares with the SEC called an S3 ASR.
And by the way, one last thing I just wanted to throw in there is this was the one for people who, have been following this trend. This is the one that, got Tom Lee to be it's like
Chairman of the
chairman or
board.
something. Yeah.
Yeah. So what they did was, anytime someone wants to sell shares to the public, unless there's some sort of exemption where you're only selling to accredited or institutional investors that don't meet the same types of disclosures, you have to file a registration form at the SEC. That could be an S1 or an S3. Uh, Bitmine filed something called an S3 ASR for a shelf registration to raise up to $2 billion in securities. And this filing meant that they could raise money in any number of ways, from equity to convertible debt and anything in between. It wasn't just one particular type of instrument that they were going to use, but they filed it with the distinction of being, for the first time, a well-known seasoned issuer of securities. And that basically means, I know one other industry analyst referred to it as almost a golden ticket, because what that means is that when you kind of sell those shares, they're immediately then retradable on the market. They're resellable on the market. There's no waiting period. The pipe shares, which was the big part of my story, those were sold to private investors, and each issuer had to then file a registration statement with the SEC after that in order to let those investors then sell those shares onto the market. That is what actually led to the price crashes of Pepsi and Sharplink. But what was very interesting about this case is that this filing from Bitmine had nothing to do with those pipe shares. In fact, I spoke with two investors who did not want to be named in the Bitmine pipe round, and they told me that they were not allowed to trade their shares. But what ended up happening is that the market got very spooked just by the fact that Bitmine was looking to raise $2 billion to sell $2 million in securities to buy more Ethereum, and the market just did not like it. It's hard to know exactly what the sentiment was. Maybe some misinterpreted this filing as the same type of filing that impacted SharpLink and Upexi, or maybe some investors just felt like enough was enough, and they were worried about future dilution. But the market clearly got spooked. And what was especially fascinating about this, and we put in the story, is that on the date of that filing, they had not sold any more stock. There was actually no dilution event. The circulating supply of shares was the same. Is the same today as it was on Tuesday or Monday or whatever. It just, I think what it showed is that investors have gotten hypersensitized to what's happening, and I think now they're on the lookout for any sign of an investor looking to rush out the door, because they know that these run-ups were built on top of very low floats, and therefore it does not take many sellers to start the ball rolling where everyone's going to rush for the exits and the price will
Yeah.
crash.
I mean, it does indicate that there will be a future dilution, right? But it's just unclear when that will happen.
Yeah, and the other interesting part too, yes, there will be future dilutions, but it's unclear when that will happen. But again, two things. One, everyone knew that was going to happen. I mean, at this point in this market, every company's trying to raise as much as they can, as often as they can. I don't think anyone realistically expected Bitmine to stay at its $215 million pipe. The second thing, though, is uh, the dilution by itself doesn't have to be a bad thing. It really just depends on how companies use their balance sheets and their cap tables. The real metric that people need to pay attention to is the Ethereum yield or the Solana yield or the Bitcoin yield metric that was again popularized by Michael Saylor. And essentially, it's a way of tracking the rate of accumulation of crypto in relation to the dilution or the rate of increase in the circulating supply of shares. And as long as that number is positive, it's theoretically a good thing. So the problem with the pipe shares is that at that point, the crypto is already there. So the dilution is just going to dilute. The denominator is going to increase, but the numerator has already increased. So that's sort of like the math problem that people are trying to figure out in their head. But what Bitmine's doing doesn't necessarily have to be a mass dilution event, especially if they sell convertible debt, which may not translate into shares until years down the line. So I think it really, the movement that we saw yesterday, and then I guess continuing into today, just shows the level of investor angst. And I think certain fears that like trying to play like the NAV game when it comes to like the price to book value of these types of companies is not for the faint of heart.
So, what do you think it makes sense for retail investors in these crypto treasury companies to consider before they invest?
So I would say be very careful, but you don't have to take my word for it. Again, I spoke for the story. I spoke to one investor in both the SharpLink and Upexi deals, who told me that he did not sell his stake in either company. I asked him why, and he basically said that, like, look, if we believe that they're good companies, they're going to be able to maintain NAV over time, even if it was bloated at the very beginning. Even from a tax point of view, it's not practical to do it, because why pay like a 40% income tax when if you hold for a year and the NAV continues to grow? You only pay capital gains tax whenever you try to sell. But that notwithstanding, what he told me is that like this is a game for hedge funds, and real professional investors that understand how these mechanics work. And his advice to individual retail investors is to not try to play the NAV guessing game. And like if you have high conviction about a stock, you can buy it, but like the best thing probably to do is to just wait until all dilution events have happened. So there's a strong float and a real price discovery can happen, so that individuals, investors can understand what the actual true NAV of a company should be.
All right. And for the companies themselves, is there anything that you think they could do to prevent these massive sell offs?
So that's a good question as well. I spoke to one lawyer who's familiar with these types of deals, and I mean, he said there's nothing that would theoretically stop companies or the boards of directors of these companies that are supposed to be independent and looking out for the shareholders from like encouraging them to like lock up their shares even proactively to calm fears, or create some sort of agreement among like the big institutional investors to not sell for a little while to avoid what he said, and I quote in the story, as some bad optics. But there's really not much that can be done. And again, one thing I want to get across in the story is that I'm not trying to create the impression that I thought that these companies did anything wrong. I mean, they saw a market opportunity. This is how capitalism works, and they put together a strategy they thought was best suited to achieve their goal. It's just that when they sort of take over these penny stock companies, and they do it in a world where like FOMO is just off the charts when it comes to these companies, like these types of run ups where stocks go up 1,000 to 3,000% in a matter of days, it's just inevitable. And then the climb back down the mountain is also inevitable. But I think what the best thing to do is probably for companies, and again, it comes down to the individual circumstances of each company. I mean, try to find a diversified approach to raising money so that you don't have these big sell walls, and just I would imagine maintain good communication with their shareholders so that when things like this happen, they can just be transparent about who's selling and when and for what purposes. But really, it's all going to come down to over time how well they're able to kind of steward their cap tables, and if they're able to sort of like accretively raise capital in order to purchase crypto and maintain the premiums on the shares, which is really what they should be judged by.
All right. Well, thank you so much, Steve, for sharing about this really, really interesting. And I mean, I just know you put so much work into this story. So, yeah, I'm glad you were able to share your insights here.
Great. Thanks, Laura.